Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, as you well know. Boy, do we have a good guest for you today. His name is Rick Ferri. Let me tell you a little bit about him, and that is, the spelling is Ferri. I'll have all his information, as you know, on my site at theannuityman.com. He'll have a permanent page there. And I want to just welcome all the people on the major podcast platforms and on the Fun with Annuities YouTube channel, where you can see Rick and I looking at each other. He is I tell you what, this is a person that is unique. And I can say that with confidence. This is a retired fighter pilot, former stockbroker, adjunct college professor, founded a firm for low advisory fees, and now has a hourly consultant advisory firm, which he's backed up and booked forever. But I mean, he's who we're looking for from the standpoint of a podcast. But yes, he started his investment career in 1989 as a stockbroker at a large Wall Street firm, kind of like I did with Dean Witter, Payne Webber, Morgan Stanley, UBS. Mm-hmm. And then he just said, hey, I can do it better. And he has core beliefs and some things that are going to align exactly with my listeners and viewers. Hey, Rick, thank you for joining Fun with Annuities. I appreciate it.
Thank you. Thank you, Stan, for inviting me. I appreciate it very much.
So we're not going to talk initially about investments. We're going to talk about fighter piloting.
Okay.
So can you give us the story there? Because I went to the Air Force Academy briefly in my career. So I know what you did and what it takes to be who you are. So can you give us the elevator speech on the fighter pilot background?
Well, I graduated from college, the University of Rhode Island, in 1980. And back then there was I want to say a 13% unemployment rate. And it was not a very friendly job market, but one of my buddies from high school had gone in the military, had a good experience with that after high school. And I was an Eagle Scout, and I was always into, camping and doing things outdoors. So I decided I was going to go into the military, and I looked around at the various services, and the Marine Corps aligned with what I wanted to do, the few, the proud, kind of the do more with less, do everything with nothing mentality that they had. And so I joined the Marines. I went to Quantico, Virginia, officer school, and they said to me, would you like to fly a fighter aircraft? And I said, sure.
Yeah, what the heck?
Right, I'd never flown before in my life, but yeah, we'll try that. So I took the exams. My eyes were good, luckily, and they went through the medical thing, and was accepted into flight school. Went down to Pensacola, Florida, which is Navy flight school. Yep. Which is all the Marines go to Navy flight school, and there is the first primary training, and they throw you through a bunch of drills. This is all the things you see on TV about, turning off all the lights and putting you in what looks like a tin can and throwing you underwater upside down and say, okay, get out, all of that stuff. So did all of that and got through it all, took the battery of exams and somehow passed. And they did a psychological exam, and I somehow passed that as well. And they sent me to start flying airplanes, and I did well enough so that they sent me to advanced fighter aircraft later on when they were selecting, and I went down to Kingsville, Texas, where I met my wife of 40 years and still married, and got my wings about a year and a half later. I had to do a lot of carrier landings and a lot of air-to-air combat and shooting things and, just all the kind of fighter pilot stuff that you watch on TV and so forth. Did all that in flight school, and then went off to fly initially A4s and then A6s. And that was what I did for about 8 years until I left active duty. And then I went in the reserves and actually retired from the reserves after 20 years. But when I left active duty, I went into the investment industry. So I think that the thing that I learned, though, most was when I was landing on aircraft carriers, because it was both day and night aircraft carrier operations, and that has to be so precise, so accurate. I mean, any screw up at all, and you hit the deck, you hit the water, you hit something, and so it's very, very accurate, no margin for error. And when I left that environment and I went to Wall Street, it was the exact opposite. It was,
Correct.
yeah, that's good enough. We don't worry about these things, and accuracy was never something that we were concerned about. And you do what you do to make your money, and that was completely foreign to me. I mean, I really didn't understand that. So that was one of my initial reactions to Wall Street when I went there from that fighter pilot and environment.
What makes you go there? I mean, what made you go into the financial services business? What was the drive there?
Actually, I have my undergraduate degree in business administration with a minor in entrepreneurial studies. So I was, very much an entrepreneur. I had put myself through college by doing basically a flea market antique business. I would go and buy antiques and various things from yard sales and auctions and clocks. I mean, you name it, and I would turn around and resell them to dealers and resell them at a booth that I would set up. So I was very much into, what is the value of things and what can you sell them for? And it interests me enough to get a business degree. And also when I was getting out, I still had a very big interest in taxes and investing and so forth. So I decided I wasn't going to be an airline pilot like all my friends became an airline pilot. I decided I was going to go to Wall Street, and that's what I did.
And you're one of the pioneers in low fee investment advice and portfolio management using ETFs and index funds. I mean, pioneers take all the arrows, and I'm sure you took a bunch early, but, and you've written seven books, hundreds of articles. People have probably read them in Wall Street Journal and Forbes and places like that. He's even won an award on a research paper he did on index investing. So, I mean, the reason that I was so happy for you to come on is I wanted you to talk about, how your core beliefs then leads into the core, what you call the Core-4, number 4 portfolios. I think that my listeners would be fascinated to hear about those 6 simple portfolio models that pretty much any investor can adopt, and they can customize as a foundation using that. And you even have put together a free website for public use on that, which we'll have on our site. You don't have to write anything down. But can you cover, I'm assuming Core-4 comes from your core views and your core beliefs. Am I right?
Well, the word core, I'm not sure. Yeah, I think that it came from the idea that investing is a whole lot simpler than what people make it out to be, especially people in the industry who are trying to make a living from this. Exactly. That, it's not that difficult. And the more you study it and the more you're in it, you realize the simpler you can make things, the better off you're going to be in the long term. If you can keep things very low cost, if you can keep your taxes low, if you could just buy it, put it away and forget it, or maybe do some rebalancing once a year, and you just don't do much. I mean, the less you do, the better off you are. The less moving parts, the better. But you would need to be broadly diversified as well. So in the Core-4 idea, which I developed probably 15 years ago initially, was what if we were just to develop a simple portfolio that might hold 4 funds, say 2 stock funds and 2 bond funds. They don't even really have to be bond funds. I mean, they could be CDs, they could be annuities, fixed annuities. I mean, they could be anything as long as it's a fixed income type allocation. But on the stock side, you do a total stock market index fund, which is a U.S. fund that holds all of the stocks on the market, and a total international fund, which holds all the stocks on the international market. And these are your 2 core holdings, along with your 2 bond holdings, let's say, and that's all you did. How would you do? And the answer is you'd actually outperform over 90% of everyone else with your investment portfolio, just doing that.
Wow.
If you're not measuring yourself against the markets, because you're not going to outperform the markets, you're just going to get the return of the markets, but you'll outperform over 90% of all other investors because they're all trying to do other things. And that's probably a conservative number, 90%. It's probably higher than that. So that was the idea of the Core-4 initially. And I talked about it for a while, and I wrote about it in Forbes, and then I actually created a website a few years ago. And what I did with that website was I took a couple of variations of the Core-4. I said, well, if you want a high dividend yielding portfolio, then you could buy these 4 funds. And if you wanted a ESG, socially conscious portfolio, you could buy these 4 funds. So it still was just 4 funds. That was the idea. And you could just, this is the portfolio, 100% in whole, done, finished, or you could use it as the core of something else where you might put a little icing on the cake, if you will. This is the cake. And if you wanted to put a little icing on the cake, you could add some other things to it. So that was the idea. Make it simple so that anybody can do it. You don't need to be paying 1% to a financial advisor or 2%. High fees. Didn't need that. Just follow this recipe, bake your cake the way you want it, and then you could add a little icing to it. And that was the whole idea. And that's what I put out there.
If anyone out there is like screaming into the at their car, if they're driving or if they're on wherever you're at, and you're saying, wait a minute, that sounds eerily familiar to John Bogle and the Bogleheads. Spoiler alert, Rick co-edited the book called The Bogleheads Guide to Retirement Planning, and he even is a host of a podcast called Bogleheads on Investing. So he's a disciple, as they say, of that simplistic type of approach. In fact, he actually will say that simple investing is actually a virtue and is really the ultimate in portfolio sophistication, which kind of leads to the whole Steve Jobs thing, is simple is complex, correct?
That's correct. Simplicity is a virtue, complexity is a cost. The more complex you make your portfolio, the costlier it's going to be. It's not going to perform as well. The fees will be higher. You'll make more mistakes. So complexity is a cost. Simplicity is a virtue. And if you can follow this with your investment portfolio, and you're going to be better off in the long term. I mean, it's a marathon. I mean, we invest our whole lives all the way up until the end. And actually, we invest for our kids and grandkids as well. So this is multi-generational. And if you can make it simple and make it low cost and tax efficient, you're going to be better off. And that's the belief that the Bogleheads have, the belief that I have. Correct.
Well, and what I like about all of this is the funds and the ETFs that Rick is talking about, they're widely available everywhere, whether you want to do it yourself or with your brother-in-law that's managing your fund, whatever it works, whatever works for you. That's what I like about it. It's simple, it's tax efficient, it's broadly diversified, it's low cost, and it works. It works. It works. And I was thinking about, as you were explaining that, to a person that's flown a fighter jet, a jet, and landed it on an aircraft carrier, market volatility probably doesn't affect you that much. Am I correct?
Well, it was funny when I came into the investment industry, people would talk about risk, and I didn't really understand what they were talking about. I said, I don't really understand what risk is. I mean, I get to go home every single night to see my family. I mean, this is not a risky business. I just don't understand what you mean by risk.
But by the way, I know people are yelling at the screen and at whatever they're listening to and say, Stan, please give this site. Okay, I'm going to have it on my site, but it's the site that we're talking about is Core, C-O-R-E -4.com. Core dash, not the word dash, but the actual dash 4.com. And on there, you can view free portfolios. You can look at custom portfolios. It's all free. Keyword free. I mean, Rick's not playing around. Now he is, I think, am I right about this? But when you started, you came from the Wall Street firms, me and you both could talk about that for a whole show, but we don't want to be negative. But when you left there, you're saying, wait a minute, this can be so simple and effective that this is really an hourly fee type arrangement. Is that what brought you there? How did you get to being one of the pioneers of hourly fee advising?
Well, a couple of things. I mean, Cheryl Garrett from Garrett Planning Network is the pioneer of hourly advising. I've been a fan of Cheryl's for 20 years, so I give her all the credit for that. I just adopted the model recently. But when I left Wall Street, the brokerage industry back in 1999, because I was, well, first of all, I wanted to do this type of investing for clients, and I couldn't do it, as you know, from being in that industry back then. You
Right.
couldn't do it. There were no ETFs. Well, there were a couple of ETFs, but it wasn't like it is now. They've really shunned anything having to do with indexing. It was all about active management and high fees and return on assets, meaning how much money you're going to get from your client portfolio for you and for us and for the firm. And it wasn't about, client centric at all, really. So when I had the epiphany of indexing back in around 1996, I decided I needed to leave that industry, but it took me 3 years to do it because I had a contract and I had to hang around for another 3 years,
Sure.
or I would have lost a lot of money.
Yes.
I had redone my kitchen. We bought a pop-up camper. And, I spent all the money that I got, and so therefore, I needed to hang out. But I did. But I just planned my escape and left in 1999 and started a low-fee advisory business, which was revolutionary at the time. I charged 0.25%, 0.25%,
Wow.
to put people in basically portfolios of Vanguard index funds and some ETFs and some dimensional fund advisors, which were kind of like index funds. And I custody at Schwab and custody at Fidelity, custody at TD Ameritrade, the clients' accounts. But I'd only charged 0.25%, and that really took off. I mean, it was. We went up to $1.5 billion, and I ended up getting bought out by a private equity investor in a rather the ugliest transaction you ever want to talk about. And we really want to talk about it there, but it was terrible. It was a terrible thing that happened. Anyway, but when I got bought out eventually by this fellow, he went and took the company a different direction, unfortunately. But I was left, without a job and short non-compete. And I said, okay, now I'm going to do really what I have been thinking about doing for a long time. I'm going to follow Cheryl's lead, and I'm just going to do advice for the sake of advice. People pay me now by the hour for advice, and that's it. I have no skin in the game, and I just do what I believe is in their best interest. And I say to them, if I were you, this is what I would do. And it's really the truth. That is exactly what I would do. I'm not trying to sell a portfolio management service. I'm not trying to sell any products. I'm just trying to help people with their financial life. And I get that's what my business is now. I work with 1 or 2 clients a day for an hour or 2 a day, and that's it per client.
You just succinctly define fiduciary.
I hope so.
That's what a fiduciary. People say, "What's a fiduciary?" Rick just did it. He's doing what he would do for himself. He's putting your best interest ahead of everything. I find it funny that we have to somewhat try to legislate people having morals and ethics. If you're in the financial business, you should by default be a fiduciary because that's why you're in it. I want to go back to the Core-4 real quick. And I was digging in last night and was really fascinated because when you go to that site, again, it's going to be on my website. You'll just link to it. It's free. There's a classic portfolio. There's a total economy portfolio. There's a global markets portfolio. There's an inflation portfolio. There's an income seeker portfolio. And even for you socially conscious people out there, there's an ESG socially conscious portfolio. You pretty much covered the full spectrum on that. Which was the first one to come? Which was the first one you introduced, and which one was the last that you introduced?
Well, actually, the first one isn't even on there. The original classic portfolio was the total stock market index fund, the total international index fund, the U.S. total bond market or aggregate bond market index fund, and a U.S. TIPS index fund.
Sure.
Now, for some reason, I didn't put that one on there, but if there was a pre-classic, that was it. And then I expanded it a little bit and said, okay, let's just do the total bond market and drop the TIPS. And go with 3 stock funds, which are the total stock, the total international, and a little bit in the real estate fund. But again, you can mix and match these however you need to. It's all, as I wrote on the website, you either take them as they are or you modify them to your needs. But the idea is simplicity. Be simple, be low cost, be consistent, stay the course, be tax efficient, all the good Boglehead type philosophy that goes behind these portfolios. And there's also funds that do it all. I mean, you could just buy a balanced index fund or a life strategy fund from Vanguard, and pretty close to the same thing, only you don't have to manage the portfolio yourself. They'll do it for you right there through the life strategy fund. So there's other ways of doing it as well to be very simple. But this is the idea. Be simple, be low cost.
With that being said, with over 5,000 mutual funds and over 2,000 ETFs, and counting, choosing amongst those can be really hard to do. On your site, you list kind of like a it's actually a 5-step process. Can you kind of go through that, knowing that, and everyone knows that everyone's situation is customizable, but can you go through the steps, the 5 steps that you laid out? And once again, it's on his site, but I think the viewers and listeners would be interested for you to explain it since you came up with it.
Well, great. Well, could you tell me first what the steps are? And
absolutely. So we're going to do it.
I'm 64,
Step number 1
so I don't remember everything I wrote.
Select a portfolio strategy.
So this would be the asset allocation between stocks and bonds. So you have to make a determination whether or not you're going to be aggressive or whether you're going to be conservative, because you want to be consistent with this. So your strategy is going to be, should I be aggressive? Should I be 80% in stocks? Should I be conservative? Should I be 50% or 40% in stocks? So you first have to decide what the cake is going to look like, and how aggressive you're going to be or how conservative you're going to be. And that's based on 2 factors. Number one, what kind of a rate of return do you need? Do you need a higher rate of return? Do you need a higher rate of return? I mean, are you required to get a higher rate of return because you're really not able to save that much and you really need to get more? And that you would need to have a higher allocation to stocks. But then also your ability to handle risk, because even if you need to get a higher rate of return, if you can't handle the volatility that implies, then you're going to not get a higher rate of return, because at the worst time of the market, you're going to pull the plug and capitulate and jump out, and that's going to hurt you. So it's a combination of 2 sides of the coin. It's your emotional, do you understand yourself emotionally, and then technically, do you understand how, what kind of rate of return you're looking for to come up with the strategy that you need, the asset allocation.
Step number 2 is choose a stock and bond mix. Now, you do have a link to the Vanguard questionnaire on there, which I think is good.
Okay. So let me reverse myself. Let me back up that. I apologize. So the strategy would simply be going to be active or passive.
Sure.
So I apologize for that. So this is actually, I already answered step 2. So this is step 1. So step 1 is, are you going to be active or passive? And that's simply, are you going to use low cost index funds?
Sure.
Or are you going to try to outperform the market? And clearly I say the benefit to you is to use low cost index funds, which leads us into number 2, which is the asset allocation question of how much you should have between stocks and bonds.
Sure. And then number 3 is just select your funds. I think that's the one that people are going to go, wait a minute, didn't you just say, Stan, there's 5,000 funds and 2,000 ETFs? And the answer is yes, I did. Select your funds. That's where you can help, correct, with this site?
Sure. So 99% of those funds are not needed, unnecessary, redundant. They're there for some other purpose other than to make you money. They're to make somebody else money.
Sure.
The funds you want to concentrate on are the total market index funds, the U.S. total market, the international total market, and you could go and screen total stock market index fund list, total international index fund list, and you'll come up with these databases you'll be able to screen for this. There's not that many of them out there. Fidelity has them, Schwab has it, Vanguard, of course, has it. Some ETFs like State Street has it, iShares has it, and they're all very, very similar. You look at the underlying index that they follow, and they're all very similar. They all have at least 2,500 stocks, all the way up to 4,000 stocks. They're all low cost. So really any of those would work well. Same thing on the international stock fund. You do total international, be the same thing. You'll get a laundry list of funds and ETFs that track the entire international market, which is maybe 6,000 other companies not in the US. Fidelity has one, Vanguard has one. There's a number of them out there. Some of them include emerging markets. Those are the ones I like. So it's both developed markets and emerging markets in one fund. So there's probably 5 or 6 really good, very low cost funds that are available by different vendors, different fund companies that are available to you. And on the bond side, there's total bond market is offered by Vanguard, by Fidelity, by Schwab, iShares, State
Mm-hmm.
Street. There's BlackRock has. I mean, there's a lot of different total bond market funds. And again, on the fixed income side, it could be different. It doesn't have to be a bond fund. It could be a CD ladder. It could be
Sure.
annuities, fixed
Sure.
annuities. It could be any. It could be a lot of different things on the bond side. But there's these are the core funds that you're looking for, and the differences between them are not much. The fees are all very, very low. Like in the stock funds, they might be 0.03 to maybe
Mm-hmm.
0.05%. They're all very low. International might be a tad higher than that. Bond funds are going to be very low. And so you can tell when you're looking at the fund, the expense ratio, really whether you've got what you're looking for, because if the expense ratio is very low, around less than 0.1%, you're probably fishing in the right lake. This is what you should be looking for.
You've partnered with a firm that offers something called the Portfolio Visualizer, which is step number 4, analyzing your selection or ongoing analysis of those selections.
Yeah.
Without thinking that people are going to go down the rabbit hole here, because we don't want them to do that, obviously. Tell us how that works and how you've simplified that.
Well, the Portfolio Visualizer, again, is a free website, and you can just type in these exchange traded fund symbols in there.
Mm-hmm.
And if you wanted to know what the performance was, which some people do, and personally, I don't care what the performance was. It makes no difference to me. That's in the past. I have a good idea why I'm investing in these funds for the future. But I mean, if you really wanted to know, you could type them all into this free website, Portfolio Visualizer, and you could see this portfolio achieved X return with X amount of risk and had so much downside and so much upside during various market cycles, and you could look at it. Now, I don't really believe that that's, I mean, I can't even recall the last time I actually calculate. People do calculate that. I have people who I get on the internet and I can find people who calculate what the rates of return are of those portfolios, but I don't, and nor do I care, because I'm not. I guess I'm after 35 years in the industry and 7 books and CFA and MBA and all this other stuff that I've done, and Masters of Science and Finance and blah 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 blah, and all the research. I realize that it doesn't really give me any information at all. What that happened. If I'm doing low cost and I'm doing diversification and I'm doing low taxes and I'm going to stay the course, I know what I'm expected to get out of that going forward. It doesn't really matter what happened over the last 5 years or 10 years. And quite frankly, it's really a distraction to go down that road. But since some people want to see, then it's there. And I did link up with them. Again, it's all free. It's not like there's any kind of a cost at doing any of this.
That's what I love. It's no gotchas. Once again, before we get to step 5, because I'll let you knock that one out of the park. Step 1 is select a portfolio strategy. Step 2 is choose a stock and bond mix. Step number 3 is select your funds. Step number 4 is analyze your selections. And step number 5, Rick, invest your Core-4 portfolio.
Yes.
That's it. Now I know you're
invest
solid.
it.
You're pull the trigger. So in other words, don't just analyze, pull the trigger, right?
Right. Procrastination. It's the last phase. So let me kind of talk about the 3 phases of this, or the 3 steps to getting this done. The first step is the philosophy, which is the what you had talked about, whether you're going to be passive or whether you're going to be active. If you're going to do index funds, you're going to be passive, low cost. So that's the philosophy that you're using. You're not going to try to outperform. And then there's the strategy. And the strategy is what we had talked about: how to select the funds, how to select your asset allocation, and then how to select the funds, and all of everything you need to do. And if you want to test it or look at it, whatever, but come up with what it is you're going to do. Now's the hard part. And the hard part is do it. Actually do it. Get it implemented and maintain it. This is excruciatingly difficult. The other stuff is interesting. I mean, there's an epiphany of the active versus passive side. Step 1, where you say, oh, wow, I get this. This is great. This is wonderful. I get the whole idea. The clouds lift. I get the whole thing. And then you start digging into the details of, okay, how do I do this? How should I do it? What should my portfolio look like? What funds should I use? How do I mix all this stuff together? And you get to that point. This is what I should do. That's kind of, stimulating, brain stimulating, if you will. But now comes the hard work, and that is do it. Do it. Well,
And that's in life. I mean, it's hard. It's hard to pull the trigger. Um, of the 7 books that you've written, and I'll read them off to the listeners and viewers. And once again, we'll have the link straight to his Amazon site so you can buy them. And the books are titled All About Asset Allocation. Another one's called All About Index Funds. Another The ETF book. 4th one is The Power of Passive Investing. 5th is Protecting Your Wealth in Good Times and Bad. 5th is Serious Money, Straight Talk About Investing for Retirement. And then the final one, The Boglehead's Guide to Retirement Planning. 2 of those jumped out at me, Rick, which is Protecting Your Wealth in Good Times and Bad, and then the Serious Money, Straight Talk About Investing for Retirement. Most of the people that are listening to this either thinking about retirement, in retirement, trying to spell retirement, but at least going in that direction. And then the other one, so we need to talk a little bit about that, but the good times and bad, which seem to always be around, can you discuss the current environment and what people, the fears people have, you talk to them just like I do, and
sure.
What's your advice, Mr. Fighter Pilot?
Well, this too shall pass. Look, investing, it doesn't come without risk. If you don't want any risk, well, you can't invest without risk, because even if you left your money in a money market fund, inflation is eating it away right now. So you have inflation, risk. It's just living has risks. So money has risks. Burying your money in a mason jar is risky. So it's not, this environment is not different than any other environment. It's always unknown. There's always something you could point to that's bad. You can always point to something that's good. That's what makes a market. We have, interest rates right now are, I never say are going anyway. So I can't say, little tongue in cheek, I cannot say interest rates are going up because we don't know that. Now, we think interest rates are going up, but we don't know interest rates are going up. And so many people have been hurt because for 15 years, they thought interest rates were going up and interest rates went down. So now interest rates have gone up. They've gone up a lot in the first quarter. In fact, more so than in the last 40 years. They've really, the people who have had money in bonds, bond funds have lost more of their temporarily because things are self-correcting in the bond market. Remember, those bonds come due, they get reinvested. Money coming in now, the dividends and interest coming in from cash-paying securities get reinvested at higher rates. So it becomes self-correcting, self-righting. Doesn't happen right away, but it does happen. So this is a shock to a lot of people who had not seen bonds lose money. I saw it back in 1994, pretty substantial losses in fixed income. But
I was there.
Yeah, but not as bad as actually it is now. It's a little bit worse now, at least up until today. And again, I don't know what's going to happen from this moment forward, but that's what has happened. And stocks have come down some, and there is a relationship between higher interest rates and lower stock prices. So the fact that interest rates have gone up and the price of stocks have come down some is no surprise. If interest rates continue to go higher, it could be stocks will continue to go lower. However, if it doesn't, that doesn't happen, on the plus side, you've got a tremendous amount of cash sitting on the sideline that needs to be invested. Even my clients' portfolios, just overly stuffed with cash and waiting to invest in bonds and stocks. Trillions of dollars out there in the banking industry waiting to be invested in stocks and bonds. So there's this avalanche of money out there that could come tumbling into the market if, say, there was a ceasefire, and whatever the catalyst is, in the UK. It doesn't matter what it is. Everything could reverse. We just don't know. We don't know those things. So how do you invest with all of these known unknowns and unknown unknowns and all of that? How do you invest? Well, you have to have an allocation that you can stick with between stocks and bonds through all market conditions. You have to be very low cost, just try to be tax efficient, do some tax loss harvesting in your taxable account. If you've lost some money, take the lemons and turn them into lemonade. Go from one Vanguard Total Stock Market Index fund to an iShares Total Stock Market Index fund. Go from a Vanguard Total Bond Market Index fund to an iShares Total Bond Market Index fund. It's not a wash sale because there are two different fund companies there. So you can take the tax loss and you can use those tax losses to offset gains or ordinary income up to $3,000 a year. So you just be smart about how to use these taxes. You make the tax loss an asset, if you will, and take advantage of doing that. So there are things you can do to take advantage of this downturn that has occurred in the market. As far as changing your investment strategy, that you don't want to do, particularly when things are either red hot or have taken a beating. That's not when you want to change your investment strategy. You don't want to become brave in a bull market, and you don't want to get scared in a down market. You just have to stay the course, and things eventually self-right after a while. But it does sometimes take a while. If you have money that you need to buy a house with, or you're going to be doing something else with that money, it probably shouldn't be in the stock or the bond market anyway. It should probably be sitting in a bank somewhere, earning very low interest, and probably below inflation interest, but that money is for your spending needs, and I don't really even count that as far as your investment. So you got to differentiate monies as well. Long-term money you need to be very patient with, and the short-term money you just need to be very safe with.
One of the things I was reading a bunch of your stuff over the weekend, actually. And one of the things that jumped out to me is something you said about there's some 3 attributes that successful investors have. And you have cultivated this over your 35 years of talking to people and helping people and listening to people. There are 3, and I want you to cover each of them, but it's number 1 is embrace a passive philosophy. Number 2 is create a portfolio strategy. Mm-hmm. And then the hardest one, maintain discipline. Now, for a Marine like you, that's an easy one. But for the rest of us, that's the tough one.
It is.
That's an easy one.
Well, a lot of my Marine Corps friends, unfortunately, who were flying jets, unfortunately, are not around today because they didn't maintain flight discipline. But okay, sadly. But
let's cover we kind of talked about passive philosophy and portfolio strategy. Can we talk a little bit about the discipline and the diehard discipline that you talk about, sticking with the plan? That's easy to say because we've all started and stopped and started diets and written down first of the year goals. But investing, this is legit. This is real. This is game time. How do you tell people to do that?
Yeah. So, the 3 things, the philosophy, the strategy, and the discipline, are really taking what you initially started with, about the 5 things, and I sort of boiled them down to 3. So I took the asset allocation side and the fund selection side, and I packaged it together into strategy. So I took that and made it 5, and I made it 3 here. So you can see the evolution of this as I try to get even simpler and simpler when describing the approach. But again, discipline is 2 sides. The first side is getting it invested. You have to actually implement it. So the first part of discipline is, now that I've got the strategy, I've got my plan, I know what I want to do. Getting it implemented is difficult.
How do you tell people to get over that hump? I mean, what do you tell them? You have a person on the phone and they just keep hemming and hawing, and this is, you've had a couple of conversations with them.
I can't get them to do it. I can't. It's
good answer.
It's like a physical trainer who says you've got to come in and work out if you want to get in shape, and they say, yes, I'm coming. I promise I am. I'm coming. I'm going to do it. I'm going to do it. And they never do it. Right? You can lead a horse to water, but you can't make him drink, kind of thing. I can show you what you need to do. I can help you create the plan. I can't do it for you. Now, here's where advisors come in, where they say they can do it, but they can only really do a small portion of it because it might be 401k plan that needs to be implemented. You may have to buy some CDs or do some other things. Some paperwork has to be done. Even as an advisor, if the client doesn't do the paperwork, doesn't follow through, there's nothing you could actually do about it. So the first phase of this is actually get it it done. Get it done. Now I've got some clients who are very, very good at it. They've taken this plan that I helped them create and they went and they got it done. And then there's the other half. The other half call me up a year later and saying, well, you're going to be really upset with me. I really haven't been very good. I kind of got some of it done, but not all of it. And then we go through it all again and say, okay, and I write out, this is what you need to do. You need to do this, 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 this. And I send it to them. And then a year later, they call back and they send me their portfolio and it hasn't really changed very much, right? So it's like, I can't do anything about that. I honestly can't. You at some point, it gets done, maybe. And if it gets done, that's the biggest hurdle. I mean, by far, once you get it done, maintaining it is easy. You know, once you go to the gym a few times and you start working out, it's easier to get in the car and go to the gym because you get into a routine and it makes it so much easier. But this is the implementation phase of discipline is absolutely the hardest phase of investing. It's not the philosophy. It's not coming up with the strategy. That's all fun and interesting. It's the excruciating pain that it seems like people sometimes have to go through to actually get it implemented. But once it's implemented, once it's done, then they're pretty much, it's easy to maintain. It's really not difficult at all.
Do you think that market timing or interest rate timing is the killer of discipline a lot of times?
Yeah, let's talk about this, and let me frame it in either when you're going to implement the strategy and you've got a bunch of cash, are you going to do a lump sum? You're going to do it all at once. So one day you're going to go in and you're going to do all the trades and you're going to get it done in one lump sum. Or you're going to dollar cost average, where it might put some in now, 3 months later you put some more in, 6 months later you put some more in, and so forth until it's all actually done. Now it sounds a whole lot more palatable to people who are looking at the market and saying, oh, the market's high, or maybe the market has come down and I think it's going to come down further. What if interest rates go up and this and that? It becomes really palatable to them to do dollar cost averaging. Well, let me tell you, it's usually not the best way of doing it. And here's why. It doesn't get done. It doesn't get done. What they'll do is, look, if you're going to do the lump sum, let's cover that first. If you're going to do the lump sum, it's painful, excruciatingly painful. And you might as well get it into your mind that if you do the lump sum and you take it all and you implement it in one day, you make the change and you do it all in one day, you might as well just get it into your head. The next day, the market's going to crash. You might as well get it into your head because it's going to, you just expect it to. Now, we don't know whether or not it will or not, but you're sitting here saying, when should I do this? When should I do it? Okay, I'm going to do it now. You might as well have in your head that your timing is the worst it could possibly be and the market's going to crash. Because if it does, then it meets your expectation. And if it doesn't, it's like, wow, it actually went up. This is incredible. I didn't screw myself. Okay. So you do it one time. It's one pain point that you have to get over, and it's a big pain point to get it invested. And by the way, statistically, that's what you should do. Mathematically, you should get it all invested at once, and don't worry about it. But people want to be able to do the dollar cost average because it just sounds better. Well, let's go to the dollar cost average person. Okay, now I got to invest $1 million. I'm going to put $250,000 a quarter for the next 4 quarters. I'm going to start today. I put it in today. I got a quarter of it invested. 3 months from now, I have to go through the same excruciating pain.
Yep.
In 3 months. Maybe that money will get invested, or maybe I don't like what I see going on in the world. Maybe I don't like this election that's coming up. Maybe I'm going to wait until, in other words, it doesn't get done. So dollar cost averaging is a great idea. And if you could do it automated where somebody else does it for you or a computer does it, great. Where you have no say in the matter. That's great, like a 401k. Yeah, the money comes out of your checking, your check or your paycheck, and it goes directly to the 401k and it gets invested. Okay, you don't touch the money. That's great. Somebody else does it. It works. But when you have to do it, it doesn't work. It's hard to do. But once you rip the Band-Aid and implement it all at once, it's done. You're not going back. You're not going to change anything. You should expect bad things to happen after you rip the Band-Aid off. There's going to be some bleeding, potentially.
Sure.
And you just expect that. Just expect that you're going to be wrong in your market timing. Expect that the market's going to work against you as soon as you rip the Band-Aid off. But here's the thing about ripping the Band-Aid. Once you rip the Band-Aid off, it's off. It's done. The account's invested. Yes, there may be some bleeding, but you're not going to change it. It's finished. You've allocated. You're invested. You're in the program now, and now you can go forward. Dollar cost averaging, you have to rip the Band-Aid off like 4 times or 8 times because you're putting this money in over a period of staging it over a period of a year or two, and it just. Ripping the Band-Aid off once is hard enough, but having to do it 4 times or 8 times is just way too hard for most people.
Couple final questions, because this has been fascinating. I could talk to you forever, but I am interested with someone of your background and knowledge and just outlook on things. What's your take on Bitcoin right here? Not the blockchain technology is obviously, I think that's legitimate technology, but the Bitcoin tulip bulb, whatever you want to call it, I'm fascinated to know what someone like you thinks about that.
Well, I don't know what the value of a Bitcoin is. To me, there is a cost to mining a Bitcoin, and that is a really fixed cost based on the amount of power that you have to use to mine a Bitcoin, and also the amount of capital you have to put in hardware to get this thing going. So there is a cost to mining a Bitcoin, and to me, at least the value of a Bitcoin should at least equal the cost to mine it, much like if you were going to be mining copper or gold or anything else. I mean, at some point, if it's not economical to mine Bitcoin anymore, then people would stop mining Bitcoin until it did become economical. So there must be some value to it because it is the currency in which these miners are paid for figuring out the algorithms and confirming the trades and so forth in the blockchain. So there must be some value to it. And to me, it's the cost to mine it. So there's so many miners out there, and you could get into the business pretty easily by just downloading some basically free software and buying some computers and then hooking it up to the grid. But the bottom line is it's hard to what is that cost? Is it 35,000, 36,000? I mean, there's a hash rate that tells us what the cost is. So then maybe that is the value, the true value of Bitcoin, and things kind of fluctuate from around that. But I don't know. Now, as far as using this in a portfolio, if you're going to treat Bitcoin as a currency, some sort of a global currency that, it's important for some countries, third world countries or emerging markets, if you want to be politically correct. This is a really an important technology that helps them transact business. But it's got a long way to go in this country and developed markets. And I say to people, if you're treating this as a currency, then are you going to put it alongside of your portfolio of yen and sterling and euro and Deutschmark? Are you going to add it to that currency portfolio? And they look at me and go, oh, well, what are you talking about? I said, well, you're telling me this is a currency. So that means you must have a currency portfolio, correct? And it's like they never thought about that. I'm like, well, how can you not have a currency portfolio if you're talking about buying this currency? And so they said, well, I don't really want a currency portfolio. I never really thought about should I have a currency portfolio? I said, no, you don't need a currency portfolio. In fact, if the world starts transacting in Bitcoin, if big companies start transacting in Bitcoin, it'll be part of the balance sheets of corporations. It'll already be in your portfolio. There'll be companies like Coinbase and so forth that'll be in the total stock market index fund. You're going to have exposure to it. You don't really have to go out and buy Bitcoin to do that. In fact, if you own a total stock market fund, you already own a little bit of this already. So
that is a very good point. Definitely. One more question, but before I do that, I was writing down just kind of who you are. I'm just fascinated with the character that you are and the personality that you are. Which is, I know my viewers and listeners are just loving this. But one last question. But before that, I wrote down fighter pilot, entrepreneur, visionary, 40-year husband, Boglehead leader, Rhode Island Ram. I know the mascot. Former Marine, investment advisor, expert, CFA, MBA, fiduciary, and all-around good guy. And with that being said, and I left out a bunch,
Yeah, I used to be
This,
the Rhode Island table tennis champion too at one time.
see, there you go. Ping pong expert. Table tennis, ping pong in the South, but I do this with all of my celebrity guests at the very end, and I never tell anybody
Uh-oh.
this beforehand. But I think you can handle it, Mr. Fighter Pilot. You've seen something, you can do it. So we're going to come in and we're going to land this thing on the deck of the moving boat. Mic drop moment. What would you tell people if you had the mic for 30 seconds to a minute? Words of wisdom from Rick Ferri.
Yeah, all this money stuff is not important. Your family is the most important thing. And if you take care of your family, everything else will work out. Happy wife, happy life. I firmly believe that. And that's where you should be concentrating your efforts. All this investment stuff, I mean, I wish I learned about indexing a long time ago so that I could have just done it with my portfolio, forgot it, and got on to those more important things.
Tell you what, if you didn't write that one down, then rewind the tape. So, Rick, really appreciate you being on and a fascinating conversation. Hopefully you'll join us again in the future. I do want to thank everyone who's watching on the Fun with Annuities YouTube channel and listening on all major platforms to Fun with Annuities, which is surprisingly one of the fastest growing business podcasts in the country. And the reason is because I have people on like Rick Ferri. So
Thank you.
My name is Stan the Annuity Man, and I'll see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.